Warren Buffett is perhaps one of the greatest figures in the business and investing world. With an estimated value of $101.4 billion at present, he is currently ranked as the sixth richest person in the world. When he was young, he got into business of tracking and predicting stock prices. And while it wasn't particularly rewarding at first, he said that it was a lot of fun. Later in his youth, he had an epiphany that would forever alter his perspective on business. He read a certain book that completely changed his perspective on investing. What is this book, you may ask? Keep watching to find out. Warren Buffett read Ben Graham's The Intelligent Investor in 1949. This book showed him how to use value investing to make money in the stock market. Graham's legacy lives on thanks in large part to the book's status as a classic in the field of finance. Never having heard of it before, the book's two essential chapters provided the basis for Mr. Buffett's investment philosophy. This is basic and straightforward, making it difficult to comprehend how something so simple could be so crucial. Number 1. Stocks are part of a business. You can't treat stock as something different. It represents a business. You assign a monetary value to a company and divide that total by the number of shares outstanding. That's the stock price. Where share outstanding means the amount of a company's stock currently held by all of its shareholders. But what else must you consider, and what attributes of the business are you studying? Its economic traits, its competition, and who runs it. Changing conditions on the stock market can have drastic effects on the stock price, but not so much the business itself. The market value or market cap of a company rises as its share price rises and drops as its share price falls, even though the business is stable and operating normally. The stock price goes all over the place, which brings us to our next point. 2. Don't react to fluctuations, but take advantage of them. Graham provides a fantastic starting point for determining how an investor should respond to changes in the stock market in his or her portfolio. In the book, he describes this fictional character he calls Mr. Market. When their investments rise, people feel good. When they fall, they feel bad. They view the stock market, or our friend, Mr. Market, as a partner in their investment endeavors, someone to guide them and give them advice. Every day, Mr. Market shows up and tells investors how much he's willing to pay for your share of the company, or how much more he's willing to buy it for. When conducting business in the real world, no one ever acts this way. Relying on Mr. Market is like riding a roller coaster. He wanders around all day and names all kinds of crazy prices, highs and lows. But you don't have to pay any attention to them, except when it's to your advantage to do so. So, let's imagine that Mr. Market is a real investor like Graham thought of. Here's how you can take advantage of Mr. Market. 1. Since the stock market is made up of investors like Mr. Market who are prone to wild swings between pessimism and optimism, the market as a whole takes on these behaviors. Mr. Market is the sum of the emotions of the entire collective of market investors, overreacting at every bit of news. 2. According to Graham, when Mr. Market is too pessimistic, an astute investor can buy stocks at a discount. And when Mr. Market is too optimistic, it may be time to sell. 3. If they keep their focus on the big picture, the businesses themselves, fundamental investors shouldn't be fazed by the short-term fluctuations in stock prices that Mr. Market inevitably causes. What's most vital is that you engage in playing only when you feel like it. Graham argues that you can't use the market action as a source of guidance or information. It does what it wants. If you want something from it and you know the underlying businesses, you can have it. Number 3. Invest with a safety margin. If you're driving a car that weighs 4,500 pounds and you come to a bridge with a 5,000 pound capacity, you'll need to keep going until you find one that can accommodate your vehicle weight. No one can pinpoint exactly what the market will do, so you'll need to keep a safety reserve in your investing strategy. Don't aim for only a narrow profit margin in the stock market. Instead, be patient and wait for a big signal. Then act. Investing is a difficult process that requires a lot of hard work, patience, and commitment. If you want to know more about how you can shield your investments, then keep watching. Understanding the business. Working with large sums of money requires an in-depth knowledge of the industry. For the sake of argument, let's say you were handed $1 million and given the freedom to invest it in 3 businesses of your choosing within 1 week. These businesses would be private enterprises, not involved in trading or anything of the sort. You have 1 week to find the 3 suitable candidate companies, or your $1 million will be returned. What are your plans for the next 7 days? What will you be considering during that week with respect to all these companies? Some of which you know well and others which you are less familiar. Some of which you know by reputation, some of which you know the management, and some of which you know their competitive situation. A great start would be to start eliminating the ones that you know you don't like, the easy ones to throw out. For example, ones with no competitive advantage. A new burger franchise in a row of established, well-known restaurants simply won't work. That way, you'll be left with only a few to deep dive into. How will you determine which businesses to dismiss? Determine what sets them apart from the competition using a variety of approaches. Brand awareness is an example. Awareness of the brand among customers is another source of competitive advantage. The iPad brand name has become synonymous with electronic tablets. That's a big endorsement of how well liked Apple's product is. While this level of recognition is likely out of reach for most businesses, those who put forth the effort to differentiate themselves by providing products or services of consistently high quality and reliability can find success. Businesses need an advantage that can keep them ahead of the competition in the long run. Because in a capitalist system, whenever one business has a financial fortress, another business will try to take it away from them. You can be rest assured that if your interior design store becomes popular in town, someone will come along and copy your designs and steal your suppliers. Try lowering your prices or adding some other competitive advantage. In that case, you should look for a castle that has a large moat surrounding it so that you can keep out competition. This metaphorical moat can take many forms, either patent protection or geographical isolation. Let's take a look at some more moats. New business must establish brand name rapidly. Great ideas spur a frenzy to get products to market as quickly as possible. To maximize the chances of success, a new business must prioritize its strategy for expanding its market share. It's crucial for a new company to make a big splash in its market, be it through public relations, advertisements, or social media. A decrease in the number of copycats and the lessening of any negative effects they may have on a new business can be expected once the company has established itself as a leader in its field. Always protect the priceless. A business must stay safe. It must first identify its most precious commodities. It could be as easy as installing copyright protection or as complex as implementing systems to detect questionable usage of a product. What is the business doing to protect itself? Taking preventative measures rather than responding to threats is the best way to shield a startup from stress, financial loss, and legal trouble. Establish strategic alliances. Has a business you're considering investing in collaborated with established names in their market? Their brand's visibility will increase thanks to the alliance, and any imitators will be unable to work with the partners involved. Honesty is important in business. Any business would be a desirable investment if they comprise of competent and trustworthy management. What are the track records of the management? Look for red flags. There are a lot of places to fall as a beginner, but there are also a lot of places to put your feet firmly on the ground. Stiffen up your upper lip. Warren Buffett's wealth is the result of many years of hard work. Even though he got a head start, he was once just like us. Just because you may feel behind the curve doesn't mean you should give up. Beginning today is preferable to beginning tomorrow. Do not dwell on your failures. Instead, focus on how you can pick yourself back up and try to avoid repeating the same mistakes. So, what do you think of Warren Buffett's sage investing secrets? Feel free to share your experiences as a young or experienced entrepreneur in the comments down below. If you want to learn more about how Warren Buffett became a billionaire, click the videos on the screen to find out. Have a nice day, and thanks for watching.